Better than expected. Jobs data on Friday, 11,000 jobs slashed from the non-farm payrolls. We also saw unemployment in the US dropping from 10.2% to 10%. Do you think this number is sustainable?
Yeah, interestingly, the 3 months prior to that were also revised upwards to the tune of 260,000 jobs. So if you put it all into perspective, there are 400,000 jobs that nobody quite knew about. Now, you must remember the labour pool was 155 million, so 400,000 as is to 155 million. It's not an enormous amount, but I think moving dramatically in the right direction, I think you could say. And that's why you saw the flow back to the dollar quite quickly, because people are saying, interestingly, that this could be the precursor to higher rates sooner than we thought. I mean, one of my favorite blogger types, Joe Wiesenthal, put up a post, my best post this year, and you clicked on it and it went through to a punch bowl and it said goodbye, meaning that the Fed are about to take away because the party is about to stop. I don't know, I would be more inclined to say, let's see the December read, let's see the January read, and then I'm sure by that time, Bernanke and the Fed, I mean, I guess he needs to be re-elected again and appointed by the Senate and the House, but you know, I'm sure he will be. See where they are and see whether or not they decide to raise interest rates.
I spoke to Wayne McCurry and George Glenos on Friday when these numbers were released, and they were both saying that it's highly unlikely that we'd see the Fed coming in and raising interest rates, especially now. It's just too soon.
I think, yeah, maybe 2 or 3 reads. And then they could say, okay, well, I'm starting to see a trend here. I think that December read's going to be quite key, and a lot of key market participants are going to be away. But you're definitely seeing all the signs that the economy is improving much quicker. And I don't know if you got a chance to see the initial claims number the day before, where we're seeing the best reads since pre the crisis. But the interesting number inside of there was productivity. It was up nearly 9%. Which indicates, imagine our respective companies trying to squeeze an extra 9% out of us without extra pay. Eventually something's got to give and you've got to start employing new people.
When we say we might be seeing the US hike interest rates at some point, we know the interest rates there are between 0 and 0.2 and 0.25%. How much do you think they'd hike by? I remember that Alan Greenspan was definitely criticized for keeping interest rates too low for too long at 1%, and now we've obviously breached that, and of course we've made history with very, very low interest rates. Sasha, where do you see things going from here?
Yeah, I think that they'd start off by 0.25, or maybe say rates are 0.25, and that's why I think they went that low, and then see and test the market there, because ultimately it's about the US housing market and keeping mortgage rates pretty low for still pretty much a beaten up sector of the market. And you saw when they took that tax stimulus away for first-time homeowners, there was a dramatic fall-off. Although that figure bounced back the month after that when they kept that stimulus. So you might see government intervention still by the way of stimulus. And the Fed are going to have to start thinking. I don't think inflation is a problem, to be perfectly honest, for the time being. And I think there are chances that if they withdraw that punch bowl, that the party could go away too soon.
Also, just looking at the Bank of America raising almost $20 billion to pay back some of its top funds. Do you think this will be a trend that we'll be seeing going forward from all the people that received the bailout packages?
Both sides want to see it, to be perfectly honest. I saw an interview with Tim Geithner on this network in which he stated quite clearly that, you know, business doesn't want government meddling and government doesn't want to meddle in business. So I think that they've got the right mix in the US, and if companies have the ability to go to the market and raise these sums of money, then that's great. That is, for me, one of the best indicators that we're returning. People are willing to risk money from the public side and not from the government side. And withdrawing government from business, that's first prize for me.
Some of the currency analysts I've been talking to said that the dollar is fundamentally weak, and we saw it at around 150 last week, and we know that it's sort of been trapped in the range of 149, 150. We saw it hit 151 as well. Now it's currently at 148 to the euro. Sasha, do you think this is impetus enough to see the dollar strengthening from these levels, the fact that we are anticipating an interest rate hike?
Yeah, I think if you look at the fundamentals, you'll probably say that the dollar should be on a weaker trend for longer. Maybe this is just a little boost that the dollar needed from here, but it clearly, for me, still indicates that is the safe trade. What does everyone sell when they see good US data? But to be perfectly honest, to see stocks and the dollar move in the same direction is normally not a trade that you see. But I think this jobs number was good enough for that to happen. In the short term, almost anything could happen, but I think in the long term, the fundamentals are still in place for the dollar to weaken against the majors, like the euro. So I think from our point of view, in trying to see where the rand goes in the short term, you obviously have to take into consideration that the US have built up massive deficits, and that they have to unwind. So I think from our personal point of view, and looking at the dollar trade in the short term, I think the rand could still strengthen up from these levels.